Part 6. Valuation and Accounting. To those of you who are uninterested in accounting, I apologize for this dissertation. I realize that many of you do not pore over our figures, but instead hold Berkshire primarily because you know that 1. Charlie and I have the bulk of our money in Berkshire. 2. We intend to run things so that your gains or losses are in direct proportion to ours. 3. The record has so far been satisfactory. There is nothing necessarily wrong with this kind of faith approach to investing. Other shareholders, however, prefer an analysis approach, and we want to supply the information they need. In our own investing, we search for situations in which both approaches give us the same answer. A. Aesop and Inefficient Bush Theory. The formula for valuing all assets that are purchased for financial gain has been unchanged since it was first laid out by a very smart man in about 600 BC, though he wasn't smart enough to know it was 600 BC. The oracle was Aesop, and his enduring, though somewhat incomplete investment insight was a bird in the hand is worth two in the bush. To flesh out this principle, you must answer only 3 questions. How certain are you that there are indeed birds in the bush? When will they emerge, and how many will there be? What is the risk-free interest rate, which we consider to be the yield on long-term U.S. bonds? If you can answer these 3 questions, you will know the maximum value of the bush, and the maximum number of birds you now possess that should be offered for it. And of course, don't literally think of birds. Think dollars. Aesop's investment axiom, thus expanded and converted into dollars, is immutable. It applies to outlays for farms, oil royalties, bonds, stocks, lottery tickets, and manufacturing plants, and neither the advent of the steam engine, the harnessing of electricity, nor the creation of the automobile changed the formula one iota, nor will the internet. Just insert the correct numbers, and you can rank the attractiveness of all possible uses of capital throughout the universe. Common yardsticks such as dividend yield, the ratio of price to earnings or to book value, and even growth rates have nothing to do with valuation except to the extent they provide clues to the amount and timing of cash flows into and from the business. Indeed, growth can destroy value if it requires cash inputs in the early years of a project or enterprise that exceed the discounted value of the cash that those assets will generate in later years. Market commentators and investment managers who glibly refer to growth and value styles as contrasting approaches to investment are displaying their ignorance, not their sophistication. Growth is simply a component, usually a plus, sometimes a minus, in the value equation. Alas, though Aesop's proposition and the third variable, that is, interest rates, are simple, plugging in numbers for the other 2 variables is a difficult task. Using precise numbers is, in fact, foolish. Working with a range of possibilities is the better approach. Usually, the range must be so wide that no useful conclusion can be reached. Occasionally, though, even very conservative estimates about the future emergence of birds reveal that the price quoted is startlingly low in relation to value. Let's call this phenomenon the IBT, Insufficient Bush Theory. To be sure, an investor needs some general understanding of business economics as well as the ability to think independently to reach a well-founded positive conclusion. But the investor does not need brilliance nor blinding insights. At the other end, there are many times when the most brilliant of investors can't muster a conviction about the birds to emerge, not even when a very broad range of estimates is employed. This kind of uncertainty frequently occurs when new businesses and rapidly changing industries are under examination. In cases of this sort, any capital commitment must be labeled speculative. Now, speculation, in which the focus is not on what an asset will produce, but rather on what the next fellow will pay for it, is neither illegal, immoral, nor un-American. But it is not a game in which Charlie and I wish to play. We bring nothing to the party, so why should we expect to take anything home? The line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money. After a heady experience of that kind, normally sensible people drift into behavior akin to that of Cinderella at the ball. They know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice. But they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They are dancing in a room in which the clocks have no hands. Last year, we commented on the exuberance, and yes, it was irrational, that prevailed, noting that investor expectations had grown to be several multiples of probable returns. One piece of evidence came from a Payne-Weber Gallup survey of investors conducted in December 1999, in which the participants were asked their opinion about the annual returns investors could expect to realize over the decade ahead. Their answers averaged 19%. That, for sure, was an irrational expectation. For American business as a whole, there couldn't possibly be enough birds in the 2009 bush to deliver such a return. Far more irrational still were the huge valuations that market participants were then putting on businesses, almost certain to end up being of modest or no value. Yet investors, mesmerized by soaring stock prices and ignoring all else, piled into these enterprises. It was as if some virus, racing wildly among investment professionals as well as amateurs, induced hallucinations in which the values of stocks in certain sectors became decoupled from the values of the businesses that underlay them. This surreal scene was accompanied by much loose talk about value creation. We readily acknowledge that there has been a huge amount of true value created in the past decade by new or young businesses, and that there is much more to come. But value is destroyed, not created by any business that loses money over its lifetime, no matter how high its interim valuation may get. What actually occurs in these cases is wealth transfer, often on a massive scale. By shamelessly merchandising birdless bushes, promoters have in recent years moved billions of dollars from the pockets of the public to their own purses and to those of their friends and associates. The fact is that a bubble market has allowed the creation of bubble companies, in entities designed more with an eye to making money off investors rather than for them. Too often, an IPO, not profits, was the primary goal of a company's promoters. At bottom, the business model for these companies have been the old-fashioned chain letter, for which many fee-hungry investment bankers acted as eager postmen. But a pin lies in wait for every bubble, and when the two eventually meet, a new wave of investors learns some very old lessons. First, many in Wall Street, a community in which quality control is not prized, will sell investors anything they will buy. Second, speculation is most dangerous when it looks easiest. At Berkshire, we make no attempt to pick the few winners that will emerge from an ocean of unproven enterprises. We're not smart enough to do that, and we know it. Instead, we try to apply Aesop's 2,600-year-old equation to opportunities in which we have reasonable confidence as to how many birds are in the bush and when they will emerge. A formulation that my grandsons would probably update to, a girl in a convertible is worth 5 in the phone book. Obviously, we can never precisely predict the timing of cash flows in and out of a business or their exact amount. We try, therefore, to keep our estimates conservative and to focus on industries where business surprises are unlikely to wreak havoc on owners. Even so, we make many mistakes. I'm the fellow, remember, who thought he understood the future economics of trading stamps, textiles, shoes, and second-tier department stores. Lately, the most promising bushes have been negotiated transactions for entire businesses, and that pleases us. You should clearly understand, however, that these acquisitions will at best provide us only reasonable returns. Really juicy results from negotiated deals can be anticipated only when capital markets are severely constrained and the whole business world is pessimistic. We are 180 degrees from that point.